Hi, everyone, and welcome back. In this session, I'm going to be talking about another trading strategy, hopefully another tool in your toolkit to help you navigate the financial markets. In this session, I'm going to be looking at smoothing out your trade execution. Some people may call it layering. I like to call it scaling in as well, and it's also something that we can adopt going into a trade as well as coming out of a trade. Now, I'll hasten to add, this isn't for every style of trade. If you're somebody that likes to turn on your system, get involved straight away, trade multiples of trades throughout the day, really looking to nickel and dime the market, where instinct and momentum are the key drivers, then this type of strategy isn't for you. But if you do start looking at a slightly longer term trading, and I don't mean weeks and months in that, but somewhere where you're looking to glean maybe 1, 2, 3% out of a trade over a slightly longer period, looking more thematic and trendy, then this may well help you. So one of the key things we look at, and why maybe we would adopt this type of trade to that scenario, is the situation where your trade idea comes to mind, you've done a bit of research, and you jump on that trade pretty much straight away. And sometimes this is a bit of a whim as well. You are also frightened of missing the boat. So we do tend to jump into trades a bit too quickly. Now, sometimes fortuitously, that means we may pick up the bottom or the top of a market, and it's very beneficial to us. But over a period of time and a series of trades, I think we're going to find if we do a little bit of extra work and planning, it can be beneficial to us. Now, once we get our trade idea, the confirmation here from me is that our execution does not have to be instantaneous, and we do tend to jump the gun. And so what we can find ourselves is buying or selling, getting into that trade at a pretty random level. And so as we always say, let the process dictate our emotions. Let's look at that process wheel. Let's make sure we do our homework. And maybe by getting in at a slightly better level, we can actually benefit from it and keep our emotions intact. Now, one of the other key things we got here from our trade ideas is literally that the market is buzzing around all the time. So once we've got our idea, let's take that moment to breathe and let's evaluate the marketplace that we are actually in. Is this a time-sensitive trade? Well, if I'm trying to pick 1, 2, 3%, then actually trading at this moment in time is pretty random. So, let's dig a bit deeper into the markets, look at our charts. We've got lots of good information coming through on TA, and this is where our support and resistance lines, the Fibonacci's, the Bollingers, etc., can really come in and help us. And that's what we're going to look at now when we look at executing this trade. So if we get to a chart, we're going to basically be coming to a point in time where the trade idea comes into play. Now, if we immediately jump in with the amount of risk that we want to play in the market, and as we always like to associate risk with our confidence, then we could be at a point where we could be trading at the high or the recent low, and that may not always be beneficial for us. So what we're going to try and do is look at scaling into a market, i.e. putting our risk into the market in a slightly different way. If we look at this chart here, and let's think, the left-hand side, maybe we've got a slight upward trend coming there, and we feel we've done our homework, and that could well continue. We could jump in and somewhere around that 110.02 level, we could buy 100% of the risk that we want to allocate to this trade. Now, as we do with trades, once we're in, we really do have to look at where we don't like that trade and how much that could potentially cost us if we were to get it stopped out at what we would classify as the right level, that right level being where the market is telling us the position is wrong. Now, we could move a little bit further on this chart and find out that way down the bottom, we have a Fibonacci level down there at 109.33. Now, if we use that as our stop loss level, we can start making some of these calculations to suggest that that original purchase at 110.02, if we were to place our stop loss quite smartly below that Fibonacci level, we would potentially looking at about 72 ticks loss. If we put it around about 30, we want to give the market a little bit of wiggle room below that actual number. If we took out a 72 tick loss on the full amount, that may be a bit too expensive for us. So how can we address that issue? Well, let's start looking at scaling in, but we need to do it in a smart manner. So why not buy 20%? And let's say our maximum trade size for this trade idea was 5 units, by example. Why not buy one of those units, i.e. 20% of our risk at 110.02? Smart idea. We want to feel comfortable that we actually have some risk on this trade idea. We don't want to be too smart and too picky and let the market run away and we've got nothing in. So we dip our toe in the water, we buy 20% at 110.02. We then look at our charts and we can look back and say, the day's low so far has been 109.64. Well, let's be smart and use that number. So why don't we layer in, why don't we scale in with another bid and try and pick up some units a bit cheaper? And let's say we try and buy another 40% of our total allocation. That's 2 more units. If we're successful in that, and as we say, we'd buy it just above that support level, the day's low, we layer in that bid at 109.70 and we buy 2 more units. The market continues and luckily, fortuitously, we get those units. What we would then look at is where do we think we can buy that final segment of our risk? There's another 40% that we can buy in, another 2 units. If we know there's a strong support down there from the Fibonacci level, we probably would be putting in a bid around about 109.40 to 50, that kind of area, to pick up the final tranche of our overall risk. So we'll stick this number in at 109.50. We buy 2 more units. At this point, we have all 5 units. But instead of buying them at 110.02, we've managed to secure all 5 units at an average of 109.68. If we maintain that stop loss down there at 109.30, because that's the correct level, we know that, then if this market continues to go down and proves to us that our idea at this point in time is wrong, then we would only lose 38 pips. Again, as we talk about, this process has helped us get into a trade a little bit cheaper. It makes us feel a bit smarter as well. So there's a good factor going on there, a good buzz in our trading. But as we always know, it can still go wrong no matter how smart we are. But again, we've been smart here. We potentially have reduced our risk to 38 ticks instead of 72 ticks on the whole amount. And that helps us trade a bit more freely as we hopefully look to take profit. Now, one of the key things here as well is risk reward. And, over time, we must always try and maintain a positive risk reward. What do I mean by that? It's basically for as the amount that you're willing to lose and risk in the marketplace. When you look to turn a profit, you should always be looking to turn that much at least, but hopefully a fair bit more. So in the first instance, if we had a take profit level up there at 110.74, let's say there was a decent chart level up there that proved good resistance, we put our offer in at 110.74, we're willing to risk 72 ticks to only make 72 ticks. So our risk reward is 1-to-1. Over a batch of trades, that's not going to help us. So by doing this at 109.68 and scaling in, we only lose 38 ticks, by hopefully taking our profit up there at the same level, our risk reward goes to 1 to 2.7, i.e. we're going to make 2.7 times the amount of profit than if we took that hit of 38 ticks. That over a long run of time and a series of trades will prove very, very beneficial. It means we don't have to get so many trades right. So that's one big advantage. One downside, as I would say, is you may not get all of these tranches. Now, from a psychological perspective, that can be disappointing. All I will say to you is we put our foot in the door at 110.02, so we can feel happy that we have some risk representing our trade idea. If it goes up straight away and we end up taking profit up there at 110.74, yes, we haven't made as much money as if we jumped in at 110.02 for all 5 units, but we will have made some money. There's a positive tone there to our trade idea. And inevitably, that's not going to happen every time. We should take comfort that we've been positive in the way we've done things. You know, we may even get the 109.70 and miss out on the 109.50. When it moves up, we've got 3 units. We've still got a positive return. But think of the downside as well. If we adopt this style, we are going to reduce some of those seriously big hits that hurt us. They dent our confidence. And that, for me, is a big, big plus in bringing this style into your trading. Hopefully that helps. And I'll be back with some more trading strategies on another night. Thank you.